Welcome everybody, and today we are going to discuss about the most awaited lecture that is on TDS. Hey, for all of you, I have uploaded the the notes in the description. You can download it from the link. Now, hey, everybody tries to understand TDS through sections, but let's try to understand with a story. In the very olden days, what happened? There was a king. The king was worried about that he was not able to collect taxes from the people. People are earning money, but they are not paying taxes to the king. And moreover, please understand, king should collect taxes and then spend for the people at large. Right? But if the people don't give him taxes, how will the king be able to spend? How will he be able to take care of the welfare of the society, right? The defense, security. So this was the concern which the king was thinking about. He was really worried what to do, what not to do. He was seriously thinking. Then he asked his mantri that what shall I do? The mantri's name was Mr. Harsh. Olden days in a modern story. Okay. Then Harsh suggested, Sir, I will tell you a proper idea. What is the idea? Practically, in the whole village, everybody is a laborer. Only there are 4 sets, 4 sahukars who are giving employment to all the people. Now, can we bring all that 4 and ask them to pay taxes on behalf of the people? And whatever they pay to the people, they will deduct this portion of tax and pay the balance to the people and tax to us. This way, we will get the tax. People will be able to pay the tax with easy convenience and will not have to put lot of efforts to collect taxes. Mantri Harsh, your opinions is really nice. And then the king invited all the 4 sahukars. The 4 sahukars said, Sir, why should we deduct tax and pay to you? What will we get? Then the king was very angry and said, Hey sahukar, if you don't deduct tax from their salaries and pay to us, then whatever the whole village is earning, on that you have to pay the taxes. The sahukar really was threatened with fear. No, this would be dangerous. And the concept of tax deducted at source came into picture. Now I will tell you what is this king. King is government who has to get the taxes. Sahukar are the source of income for the people at large. We can say the businessmen in today's language, the employers in today's language. Now what happens? Catching hold of whole public at large, all the employee community, all the income earners, really difficult. But is it possible to catch hold of the people who are paying to a large chunk of people? So suppose take in today's context, Reliance, Adani Group, Tata, Wipro, Poonawallahs, our Serum Institute. Like that, if we take top 20 to 50 companies, they pay to most of the people. Whatever people in the society are earning is because of these 10-20 companies, top companies in our country. So if government forces them to deduct the tax and pay to government and balance amount of income the people will get, this way government can ensure prompt collection of taxes. So tax which government has to get from the people is deducted at the source. At the source means the source of earning income. Suppose I am working in a university, then university is the source of income for me. University is the employer. University should deduct tax and pay balance salary to me. This way, government will ensure prompt collection of taxes. Moreover, government cannot wait till the assessment year, next year, to get the taxes from people. Because if people are not in mood, people delay, government planning, expenditure management again will fail. Right? Government is accountable to people. But at a micro level, each individual is not accountable to government. Or government cannot make them accountable so comfortably. So that's why this system of tax collection, TDS, was introduced and government's job became easy and government is able to collect more and more taxes. Time to time government is bringing lot of changes to TDS concept to collect more taxes, prompt taxes from the people at large, from the organizations and from the individuals. So hope you enjoyed the introductory part of this lecture, that what is TDS and how this is interesting. Now let us understand so many things about TDS which I am going to share with you. First thing, who should deduct the tax, right, which we discussed till now. Whose income the tax should be deducted from. Suppose example, a daily laborer is there earning just 10,000 rupees per month, not daily, per month 10,000. Yearly how much? 1,20,000. Is he earning something on which he can pay tax? In India, basic exemption limit is 2,50,000, right? Yes, sir. So, is he earning even 2,50,000? No. So, should the employer deduct tax for that laborer or that individual whose income is less than 2,50,000? No. So, suppose a person has taxable income, for that tax can be deducted from the source. And if somebody has no taxable income or income less than the basic exemption limit, no need to deduct tax. Quite simple. Yes or no? So, who should deduct tax? When it should be deducted? On what amount the tax should be deducted? At what rate the tax should be deducted? Right? When government can give relief in deduction of taxes. So many questions are there which we are going to understand and get the answers for. So are you ready to travel with me on this exciting journey of learning TDS? Yes. Then just put on your earphones and start listening with lot of care. Start writing some notes if possible. Obviously you can download the notes from the description. Hope you would have given the thumbs up and subscribe to the channel. So now let's continue. So we understood the concept behind tax deducted at source. The logic behind we understood. Now let's continue when the tax should be deducted. Hey, if suppose the employee has taxable income, then only tax will be deducted. Or if the person who is earning income, his income is taxable as per the law, as per the Income Tax Act, then only tax should be deducted. Okay, very good, clear. Now, next. Now we should understand the general rule that tax need not to be deducted, or when it should be deducted we are going to discuss. Okay, when it should be deducted, at the time of payment or at the time of crediting the account of the payee. Please understand who is payee here. Payee means a person who is going to receive the amount. Okay, payee is a person who is going to receive the amount. So when the payee is credited or when the actual payment is done, at that time the TDS has to be deducted. Now which one? Whichever is earlier. दोनों में से जो पहले है वो. Right? Which one is earlier? दोनों में से. At the time of payment, at the time of credit whichever is earlier. Now I will tell you for simplicity of understanding. Let's take salary example. Salary, if I try to take, you will be confused because salary only at the time of payment. So suppose there are many other payments which are done. So many other payments, what happens is the payer has to write the name of the person who has to receive the money, right? जो रिसीव करने वाला है उसका नाम तो लिखेगा एज ए क्रेडिटर, राइट? क्रेडिटर इज क्रेडिटेड, राइट? यस. So at the time of payment or credit, whichever is earlier, you have to remember. Now this is generally done, but there are some cases where we will not do so. So in the following cases, TDS is deducted at the time of payment only, right? So at the time of payment or credit of payee, whichever is earlier, that will not apply. TDS should be deducted only at the time of payment in the following cases. So what is the question which we are answering? If suppose in your exam they ask you when TDS should be deducted, so we will write generally at the time of payment or credit whichever is earlier, but in the following cases like salary, employees provident fund payment, winnings from lotteries or maturity of life insurance policy or compensation on compulsory acquisition of property, government compulsorily acquires the property. In these cases, what will happen? The TDS should be deducted at the time of payment. Come on, remember. In which 5 cases? Salary, EPF, compulsory acquisitions, winnings from lottery, maturity on life insurance policy. In these 5 cases, at the time of payment. In all other cases, payment or credit of payee whichever is earlier. याद आ गया? पक्का? Yes. Next, general rule. TDS is deducted at which rate? Flat rate. Sometimes 1%, 2%, 5%, 10%, right? Flat percentage. But if it is TDS has to be deducted when we are paying to NR, non-resident, or when we are paying to foreign company, or when we are paying salary. In these 3 cases, non-resident we are making payment, foreign company we are making payment, or we are making payment to, yes, salary. Salary may be to resident or non-resident, does not make a difference. So in case of payment of salary, or if it is payment to NR, if it is payment to foreign company, not only the rate of tax but surcharge plus health and education cess should also be added. So surcharge and health and education cess will be added only in which case? If it is payment to NR or to foreign company, or in a situation where salary is paid. Clear? Very good. Now, tax is required to be deducted not only from payment of for commercial purpose, but also in cases where the payment is for personal purpose. Right? Sometimes personal payments are there. We are paying to contractor for construction of our building. So he is rendering some service to us. Here also we may have to deduct TDS. Now we will discuss in detail, don't worry. Right? So TDS has to be deducted sometimes in commercial transactions, sometimes in personal transactions. It may be anything. But I will tell you more important thing than this. When it should be deducted? If it is specified in Income Tax Act. So Income Tax Act gave some specific situations, some specific cases. In that case only TDS has to be deducted. Not in every case. So if the rule satisfies, if the law satisfies, if the law forces you to deduct TDS, then yes, you have to. If payee does not furnish his PAN, if payee don't furnish PAN, no problem. Then whatever the rate of TDS or 20%, whichever is higher, the rate of TDS should be at higher rate. But this is not the only problem if you don't furnish PAN. If you don't furnish PAN, your TDS will be deducted at higher rate. Not only that, but tomorrow when you show your total income and pay the tax, at that time, government will not give you the benefit of this TDS. Okay. Generally what happens, on our total income tax will be calculated. Okay. Yes, sir. And then whatever already tax is paid in the name of TDS or advance tax or TCS, you can check out the other videos too. So that will be deducted and balance we have to pay. But if you don't furnish PAN, then government don't know that it is your tax which is deposited with them. So you will have to pay tax on total income. You will not get the benefit of deduction of TDS which you actually paid. So that's why please furnish PAN whenever required. If somebody don't furnish PAN, those who are into criminal activities or illegal activities or want to maintain black money, for them TDS by the honest citizens or honest corporate organizations, TDS will be deducted at the rate or 20% whichever is higher. But if it is the case of 194O e-commerce transactions, which we'll discuss, it's an amendment, then 20 will not be considered. 5% only will be considered. That means TDS will be deducted at the rate specified or 5% whichever is higher. Rate specified or 5% whichever is higher. In which case 194O. In all other cases, rate specified or 20% whichever is higher. But if the payment is to a non-resident or if it is to a foreign company, then if the payment is of interest, dividend, royalty, fees for technical services, what I said, interest, dividend, royalty, fees for technical services, or payment in case of transfer of capital asset. That means we are transferring the property, right? For that we are making the payment. Oh, that means the non-resident is transferring property to us. For that we are making payment. Can we deduct TDS for such non-resident or for such foreign company? The answer is no, no, no. Okay. So what they said, interest, royalty, fees for technical services, dividend and payment on transfer of capital asset. Higher rate of TDS will not be deducted. Higher rate of TDS which we discussed not 206 AA section, that will not be applicable to non-resident if they provide these following documents. Now what are they? The name of the non-resident or foreign company, their email IDs, their contact details, their address for correspondence, for communications, and certificate of his being resident in any other country outside India. So tax residency certificate we call it as. That has to be submitted, right? And if they have any tax identification number, like in India, PAN card is the tax identification number. PAN is the tax identification number. If it is there, that has to be submitted. Otherwise, whatever their identity card in that country, that has to be submitted. So name, email ID, contact details, residential status, their address, their residency certificates and their tax identification number. If these things are submitted by non-resident, then in case of interest, royalty, fees for technical services, dividend and payment in case of transfer of capital asset and TDS should not be deducted for such non-resident or such foreign company at a higher rate specified under 206 AA. याद आया थोड़ा सा? वही 20% वाला, वो नहीं लगेगा. If payment is made by payee without TDS, so generally TDS has to be deducted. Okay, the payer should deduct TDS. But if payer did not deduct TDS, so what happened? Without deducting TDS, payer made the entire payment to the payee. It does not mean that the payee need not pay any tax. It does not make the payee irresponsible or free from liability to pay tax. Payee is still responsible to make the payment of tax. When payee files the return, he has to show the income, he has to pay the payment of tax. Suppose if the payer deducted the tax, but did not deposit the tax with the government, then payee will not be held responsible. If payer deducted the tax but did not deposit, then payee will not be liable. But if payer did not deduct the tax, did not deposit the tax, then payee will be responsible. We have to remember this. Cannot excuse. Okay? Yes, sir. Now, we will start with the sections, and that is first TDS on salaries. Hey, government gets the highest amount of revenue from the middle class people who actually get salaried income. Because poor people don't earn income to pay tax, and rich people have a lot of plans so that they can avoid tax or save tax, whatever way we can call it. So salary is the major source through which government collects the reasonable fair amount of taxes. So 192 talks about TDS on salaries. Now obviously who will pay salary? Employer will pay salary. So he will only deduct the tax. Who will get the salary? Employee will get the salary. Yes or no? So employee will be getting salary. He will be called as payee, and on his income, that is salary income, employer will deduct tax and pay to government. Now when TDS is to be deducted, already we discussed, right? If it is salary, EPF, you remember, the TDS should be deducted on payment basis. कब? जब payment होगा तब, right? When the payment is done at that time. Like this, we have to understand about the salary topic. Now, what they said about salary, that employer will pay to the employee. So employer will deduct TDS on salary and pay the balance to the employee, and whatever TDS deducted by the employer, that will be deposited with the government in the name of employee by mentioning the employee's PAN number. There is a software called as Traces. It is done through that software or that website. Okay. So we'll see one by one each and every slide in detail. So let's recap. TDS on salary we are discussing under section, yes, come on, try to tell with me, section 192. Who should deduct? Employer should deduct. Okay, whoever is the payer, employer is the payer here, he should deduct the tax. Okay, and when it should be deducted? At the time of payment. We discussed it, right? Chalo, come on, let's continue. Rate of TDS. What is the rate of TDS? Generally what happens, employee's salary income, what is the tax to that employee? Because employee is an individual. Individual means slab rate basis, 0 to 2 lakh 50, nil 2 lakh 50 to 5 lakhs 5%, something like that slab rate would be there. So whatever slab rate based tax will be there on salary or the total income of the employee, that tax divided by the total income into 100 we will do, and we'll get the average rate of tax. And on that average rate of tax, using that average rate of tax, TDS would be deducted every month from the salary of the employee. Again, I am telling to you, what is the rate? Is there any particular percentage? 1%, 2%? No, there is no particular percentage. Suppose example, employee salary is something around 12 lakhs per annum. 0 to 2 lakh 50, nil 2 lakh 50 to 5 lakhs 5%, 5 lakhs to 10 lakhs 20%, 10 lakhs to 12 lakhs salary I said, right? 12 lakhs 30%. Now calculate the tax. Can we add surcharge? No, it's not more than 50 lakhs, right? So no surcharge. Can we add health and education cess? Yes, we should add. Now once we add surcharge, health and education cess as applicable, whatever tax comes, take that tax, divide it by total income, into 100 you will get average rate of tax. And that average rate of tax we have to multiply with every month's salary. That percentage we have to multiply with every month's salary, and whatever amount comes, that would be deducted as TDS. Balance will be paid to the employee. Suppose example, something around 1,80,000 comes yearly salary, yearly TDS. So something around 15,000 will come per month. So if salary is 1 lakh per month, 15,000 would be deducted and balance 85 will be paid to employee, 15 will be paid to the government. So roughly I said, okay, please understand. So this is how rate of TDS would be. Now can we deduct deductions? Yes, all deductions will be done while calculating total income of the employee. Okay. Yes. Now deductions will be deducted, but very important thing, there is something called as TIN number. So TIN number as of now is irrelevant now, because when the employer files his TDS returns, quarterly they have to file. They file the TDS returns through NSDL website traces. From there they will get the certificate. They will give that certificate to the employee in form number 16. So this is irrelevant as of now presently in practical world, but from your exam this only is relevant because CMA institute has given. Let's go to the next thing. As per provisions of section 206 AA, right? If resident payee fails to provide his PAN, if the resident payee fails to provide PAN, then what is the TDS? Either the rate, average rate which we discussed, or 20%, whichever is higher. Average rate or 20%, whichever is higher. Then other points, very important thing, maximum exemption limit. Suppose your salary is less than 2,50,000. Will there be any TDS on your salary? The answer is no. So if your income is not taxable, no TDS. Sometimes what happens is your employer gives you some benefits, like perquisites are given by the employer to you. Suppose maybe a car is given, maybe rent-free accommodation is given, something like that is given. Now not only the employer gives you the facility, the perquisite, but the employer pays tax on it. Whatever average rate of tax comes on the perquisite value, taxable value of the perquisite, that employer only will pay from his pocket. Now the question comes, there are so many questions comes. First thing, from employer's perspective, is it allowed as deduction to the employer? Whatever tax he paid on the perquisite to the employee, that tax will the employer be able to deduct from as expenditure? The law says no, under section 40, disallowed for the employer. Okay. Will the employee be taxed on the tax paid by the employer? Will it be considered as perquisite? Because employer gave rent-free accommodation, motor car, some facility to the employee. Now that facility, whatever tax comes, that also employer paid. Now facility is taxable to employee, but is it the tax also taxable to employee? The answer is no. Tax is exempt. Tax paid by the employer on behalf of employee on such perquisite is exempt in the hands of employee. This we should be able to remember. Let's go to next. What they said. They said salary from more than one employer. Suppose if you have more than one employer, 2 or 3 employers are there. You are working from different places. So employee need to submit to the employer some form called as 12B. Kaunsa form? 12B. And give details of the other employer to one employer. Suppose example, somebody is working in Reliance Industries and he is also working with me. Now whatever salary the employee is getting from me, he will disclose to Reliance Industries in form number 12B. Now Reliance Industries will club their salary, my salary to the employee, and on the total they will deduct the TDS. This way TDS will be deducted. Come on. Treatment of other incomes. If other incomes are there, that would, if the employee communicates to the employer, that also employer will to club it, total it, and calculate the rate of TDS. So other incomes, even if it is from salary, house property, PTP, capital gain, other sources, if the employee gives the details, employer will add all the details, and employee is required to give such details to the employer as per the law. So employee will give, employer will count and calculate the rate of TDS. So such other incomes the employee will give details. If on that incomes any TDS is deducted, sometimes what happens, you won a lottery. On that TDS is deducted already by the lottery organization. So you should communicate the fact to the employer that okay, this is the other income I earned, but on that TDS is also deducted. Okay. Can you show the losses also? The answer is yes, you can show the losses also, but only from house property. So you can give to the employer the loss details also, but only from house property, not from any other head. Okay. Now the employer will calculate. If you give other income details, including that other income details, the employer will calculate TDS and deduct from your salary. If you did not give other income details, so whatever employer has the information on that, that is salary or many or some others, on that he will deduct the TDS and he will deposit with the government. This is how it happens. Now, evidence of claim. What is this evidence of claim? The responsible person shall, for the purposes of estimating income of the assessee or computing tax deductible, obtain the evidence or proof or particulars of prescribed claims. Now, at the start of the year, the employer asks you that, sir, I am going to invest in LIC this much, I am going to invest in Provident Fund this much, medical insurance this much, and employee always try to get lower amount of TDS. But by the end of the year, in February month or March month, the employer will ask that, did you pay LIC? Did you pay Provident Fund? Please show, pension, Provident Fund, yes. Such details should be shown. Who will ask? Employer will ask. And if suppose employee did not pay, then the employer will deduct the higher rate of TDS. And that's why when year ends, many employees who show higher investments and pay deduct less TDS because of that, at the end of the year they don't complete that requirements. Last month's salary they don't get because entire amount is deducted in the name of TDS. Yes, this happens. Now, TDS on ESOP. This is very important thing which we have to understand. What is TDS on ESOP? ESOP means Employee Stock Option Plan. ESOP means Employee Stock Option Plan. To promote the feeling of ownership amongst the employees, the ESOP is introduced. So employees who are sincere working in the organization from some years will get some shares, stock options, we call it as ESOP. Generally it is given at a lower price than the market price. Lower than the market price. Now how it is commonly taxed? Two things to remember. This is more prevalent in case of startups actually. More relevant in case of startups also. Why? Sir, because startups cannot pay more salaries, they compensate the talented employees by giving shares in the organization. Yes sir, very good. So how it is generally taxed? ESOP market price of the shares, minus the value at which the employee exercised the option. The difference is taxed as perquisite. In the hands of employee. Okay? Yes. At the time of exercise. And when the employee sells that shares, capital gains also arise. So when the employee exercises the option, salary income, market price of the share minus exercise price, perquisite. And when they sell, capital gain, sale price minus exercise price. If there is any indexation, capital gains chapter, indexation will be there. So if it is required, that will be done and capital gains will be calculated. But for startups, this is not suitable because the problem is the employee is getting shares. He is not getting any money benefit now, right? More than that, money is paid by the employee from his pocket to some extent. Now, paying tax on the benefit received now is practically impossible because the employee don't have cash. So, to solve this cash problem for startup companies only, okay, whatever I discussed till now is for all companies generally. But now what I am going to discuss, this is very useful for your salary also and is an amendment also. So be careful, listen, concentrate what I said. So when TDS should be deducted or when tax should be paid by the employee? They said within 14 days. When? Within 14 days. From what? From the three things which you can see on the screen, earlier of the three. Suppose today you exercise the option. We will call this as previous year. And once the assessment year is over, from that time 48 months time should be calculated. Calculated. Done. Second important thing you should concentrate on. Date of sale of such specified securities. When you are selling such specified securities, that you have to calculate. Or take the third thing important. When you left the job, did you leave the job? The date of leaving the job. Did you sell the shares? Date of selling the shares. Did you continue after the assessment year for 48 months? End of the 48 months. Now once you write all the three dates, check what is the earlier of the three. Once you write the earlier of the three, from that date, within 14 days, the employee should either pay the tax to the government or the employer should at least deduct the TDS. If suppose the employee is continuing in the organization, then employer may deduct TDS. If he is not continuing, then maybe employee has to pay the tax. Simple as that. Right? Chalo, continue. The tax shall be deducted or paid at the rates in force of the financial year. Now you may get a question. Sir, what should be the rate? So that's why they say rates in force of the financial year in which the sale of security or sweat equity share is allotted. So if it is sold, then average rate of tax for the year of sale. If it is not sold, you are continuing as an employee or you did not sell but you left the job, then average rate of tax in the year when the shares are allotted to you, or if you sold the shares, then when you sold it. So this way you should remember. If you sell, then average rate of tax for the year of transfer. If you continue, then allotment, right? Like that you should be able to be thorough with. If the employee pays tax directly, the employer is not deducting tax. Same provision, same rate he should pay. Like this, we should be able to understand the details. Now, TDS on the provident fund we are going to discuss, and that is under 192A. So 192A TDS on provident fund we are going to understand. Come on, try to concentrate. What is provident fund? Hey, employer actually pays you some provident fund, right, for your retirement benefit. Here employer also contribute, employee also contribute, right? Yes, it is under Employees Provident Fund and Miscellaneous Provisions Act 1952. You remember? Yes, in law we discussed it. Very good. Now, when we contribute, for our contribution we get ATC deduction and employer's contribution is taxable. But when we withdraw, how much it is taxed? Is it really taxed or is it not taxed? If it is taxed, what should be the rate of tax? All that we are going to discuss under section 192A of this chapter. You all remember here, obviously when payment has to be made, who will make the payment? Employer? No. Because employer, his share, employee's share, he will deposit with the Provident Fund office. And Provident Fund is managed by Central Board of Trustees. Managed by whom? Central Board of Trustees. So Central Board of Trustees will make the payment to the employees who want to withdraw the Provident Fund amount or who have retired, now they want the money, right? Now, generally, if withdrawal amount is less than 50,000 or withdrawal is after 5 years of service, the withdrawal is not taxed. If it is because of health reasons, not taxed. But other than that, if it is withdrawn, then it would be taxed, and on that TDS has to be deducted by Central Board of Trustees at the rate how much? 10%. So we'll discuss this in detail now. So we understood all the provisions. Now let us recap with the slides. So what they said, TDS on the payment from Employees Provident Fund, 192A section. Now everybody know who will make the payment? The Central Board of Trustees. Under which scheme? Employees Provident Fund Act 1952. Okay, very good. Now from which balance? From the accumulated balance. Every month employee contribute, so all the money will be added. So when we add everything, we accumulate, right? So from the accumulated balance the payment is done. By whom? The Central Board of Trustees. To whom? To the employee, when the employee requests withdrawal. Okay. When tax shall be deducted? At the time of payment. Come on, try to remember, at the time of payment. Tax is deducted on what amount? Whatever accumulated balance is withdrawn, on that tax will be deducted. Okay? Yes, sir. But if it is because of Rule 8, Part A of the 4th schedule, Rule 8, Part A of the 4th schedule, nothing but ill health, withdrawal because of after 5 years, withdrawal less than 50,000. So in these cases anyhow no tax would be there, right? That's what they will discuss. Let's see. So what they said, Rule 8 we started. So Rule 8 what they said, did you withdraw? Yes sir, I withdrawn. Okay. You withdrawn, but did you render 5 years service? Yes sir, I have withdrawn that the PF amount, Provident Fund, after giving 5 years service. Oh, then no problem. Next, did you withdraw without completing 5 years service? Yes, sir, it is the case that I did not complete 5 year service. But, sir, I had health issues. Okay, then no problem. Health issues, medical issues, we understand. Sir, I don't have health issues, but the company closed, sir. Okay, then no problem. Even though you withdrawn within 5 years, we will not tax you. So obviously no TDS, because maybe it is health issues, maybe business discontinued, maybe you shifted to new organization and you transfer the PF balance to the new organization. Then also no problem. We will not deduct TDS, you will not be taxed. Very good. Because now you are not the employee and you joined other employment, then also okay, no problem. But only thing, you have to transfer the balance to the new employer's RPF, and in the new organization RPF should be there. Okay, sir. If the accumulated balance paid to the assessee is exempt, obviously if it is exempt, then obviously there will be no TDS, right? Very good, sir. What is the rate of TDS? 10% is the rate of TDS under 192A. What is the rate? 10%. And 10% is flat. No surcharge should be added. No health and education cess should be added. Flat 10%. Okay, if any employee has to receive any amount which is deductible, he has to furnish his PAN number. Obviously, PAN number should be furnished. So that what will happen? The same 10% will be deducted. Right? If PAN number is not furnished, then what will happen? Generally, it is the rate, that is 10% or 20%, whichever is higher. But here it is not the rate or 20%. Here it is maximum marginal rate. And you remember what is maximum marginal rate? 42.774. 30% plus 37% plus 4%. You remember? Yes, sir, we remember. Very good. Now, where TDS is not applicable, TDS where it is not applicable, aggregate amount of such payment does not exceed 50,000. Already we discussed it. Yes or no? So perfect. Excellent. Everybody understood. So this is about all about 192A. TDS on withdrawal from Employees Provident Fund. Now we'll start with 193 TDS on interest on securities. Now what is interest? Interest is nothing but a financial charge. Suppose you take a loan, you pay interest, yes or no? Yes. So that is what interest is. Now here we are not talking about interest on loan something. We are talking about interest on securities. Securities is nothing but bonds, debentures, right? Any debt instruments issued by corporates or issued by the government. Okay? It's not a normal bank loan which is discussed here. Normal bank loan will come under 194A, we'll discuss, don't worry. But, or savings bank deposit interest, recurring bank deposit interest, FD interest, all that will come. Yeah, don't worry, that will come under 194A. But here we are only discussing about interest on securities. And what are securities? Bonds, debentures. Okay, clear. So interest on securities, what is the rate? 10%. Who will deduct? Obviously the company or government, whoever is issuing the bonds, whoever is paying the interest, they will deduct. Right? So this way we have to understand this topic. Very easy, very sweet topic. We'll go through the slides to understand everything in detail. Now, TDS on interest on securities, which section? 193. Okay. Who is responsible to deduct tax? Any person responsible for payment of interest on securities. Right? Generally companies will be there or government will be there. Please remember. Okay? Generally companies or government. Okay? Now here they said other than interest on government securities, right, and certain specified securities to any resident, very important word, to any resident person. What does this mean? This means that if any interest is paid to non-resident, it will not come under 193. If interest is paid to non-resident, will come under section 195, 195, 195 only. So if you are paying interest to non-resident, 195. But if you are paying to resident, payee is resident, receiver of interest is resident, then only 193 section attracts. So who should be the payer? Who should be the deductor? Either the government or the corporates. This is simple way to understand. Note, in the following cases, tax is not required to be deducted. Now what are the cases? Interest payable to a resident individual or a resident HUF on debentures is not subject to TDS provided following conditions are satisfied. What are the conditions? Such debentures are secured by company in which the public are substantially interested. Now here they are conditions actually. Public are substantially interested. कब बोलते? If 25% of the shares are held by public at large. Okay. So if public are substantially interested, first condition. Okay. Second condition. Such debentures may be listed or unlisted. So anything is okay. Right. The interest is paid by the company by an account payee check. That means payment should be through account payee check. And last thing they are saying that the amount of such interest is up to 5,000 or does not exceed 5,000. So if these four conditions are satisfied, come on, try to recollect everything. What are the first thing to remember? That the debentures are issued by a company in which public are substantially interested. That means basically 25% of shares are held by public at large. Second important thing, company may be listed or unlisted. So mostly they are public companies. Okay. Third thing, interest is paid by the company by an account payee check. So if they are paying through online mode and it's up to 5,000, government says these are very small payments, need not deduct TDS here. Right? So four conditions, all four are compulsory. So the company should be a company in which public is substantially interested, maybe listed or not. Payment should be through account payee check and up to 5,000 interest is paid throughout the year. If these four conditions are satisfied, government will say, okay, no problem, no need to deduct TDS on interest here. Okay. Any interest payable, hey, when you see this star, please remember it's a new point. Okay, very good, sir. Now, four circles are there, right? Any interest payable on any security of the central or state government. So, if it is central government security or state government security, government knows that to whom they are paying. And people cannot escape taxation because it is government securities, government has a record of it. But still government said if it is 8% taxable bonds 2008 or 7.75% savings taxable bonds 2018, in these two cases, even though it is government, come on, please remember, even though it is government, still TDS has to be deducted. So 8% savings taxable bonds 2008 and 2003 and then they said 7.75% savings taxable bonds 2018. In these two cases, even though it is government, still TDS has to be deducted. So if it is bonds issued by central government or state government, no TDS generally. But if it is savings bond 2008 or 2003 or 2018, then yes, TDS has to be deducted. Come to the next point. So when to be deducted in government, when not to be. Please differentiate, okay, in your mind. Any interest payable on any security issued by a company where such security in dematerialized format. Now when it is dematerialized format through a recognized stock exchange, government has proper record of it. There is no chance that you can avoid tax. So government says, okay, if it is demat form, will not ask you to deduct TDS. TDS deduct करने की जरूरत नहीं है. Interest payable on securities beneficially held by life insurance. If the holder is life insurance corporation or general insurance corporation or any company under that or any other insurer, maybe it is Max Bupa insurance or ICICI insurance or HDFC insurance, still government has trust on such insurance companies because they maintain proper database, proper records. So that's why TDS need not be deducted when you are paying to an insurance company. Hey, you cannot become an insurance company so easily. For that you need to be registered under IRDA. IRDA means Insurance Regulatory Development Authority. So that's why government says, okay Baba, no need to deduct TDS in this case. Any interest payable to regimental fund of non-public fund established by armed force, right? Income of which is exempt under section 1023 AA. So obviously army related matter, right? तो थोड़ा सा सैल्यूट तो बनता है यार, right? We should salute our army. And if they are earning any income, right? In India, Gorkha regiment is there, Sikh regiment is there. So for that some funds are allocated. That funds are invested in some security and that funds are earning income. No, it's exempt. Very good. Now, when tax shall be deducted? At the time of crediting the pay or at the time of payment, whichever is earlier. Okay. This is quite common for all of you. Right, sir. Now, what they said. Where any amount is credited does not mean just crediting the party. If it is interest suspense account credited or suspense account credited, still we will call it as credited the payee. So please remember that. What is the rate of TDS? Generally it is 10%. Generally it is how much? 10%. But during the period of 14th May 2020 till 31st March 2021, COVID time, right? So slight relief is given and TDS rate is 7.5%. During this period, TDS rate is how much? 7.5%. Generally how much? 10%. No surcharge, no health and education, sir. Exemption on relaxation from the provisions. There is some relaxation. Suppose example, you are a senior citizen or your income is less than 2,50,000. In any one of the cases, you can submit form number 13 or form number 15A under section 197 and you can get the benefit. कि ठीक है यार TDS मत deduct करो, don't deduct TDS, or please deduct but at a lower rate. Like that you can fill the form and convey the message to the employer and that can help you to deduct tax at a lower rate. Now 197 I will discuss at the end of the chapter in detail. Don't worry for that. Okay? Yes, sir. So till now we understood about section 192, 192A, 193. Now please go through all the notes given in the description link so that you will be able to get full clarity about the concepts. In the second part of the video we will discuss 194 and entire TDS would be revised for you. Okay, so we'll meet in the next video. Till then, take care and do subscribe to the channel and comment how you felt about this pattern of recording the videos from my side.